Now we pivot over to China, and it's important to look at where the numbers are in general. So when you look at composite PMI, the previous was 52.9, came in at 56.4. Manufacturing PMI was expected to be at 50.6, came in at 52.6. Non-manufacturing was expected to be at 54.9, came in at 56.3. Caxon manufacturing expected to be at 50.7, came in at 51.6. So all of them well into expansion. Manufacturing, so this is the key piece for those that have been following us is, we had said that manufacturing was not going to be as strong as non-manufacturing because manufacturing didn't go down the same way as non-manufacturing services because people were locked down. You could still buy stuff and have it delivered. The government was still buying it on your behalf and dropping it off. And also, they were maintaining exports to a certain degree. So there was always that manufacturing piece in general. But it's also important to look at it from the perspective of it's a diffusion index. So different pieces will weigh differently. You had a massive improvement in the supply chain, not surprising. You had a massive shift in inventories, not surprising. As you get some of that normalcy, so there's a little bit of excess in this. But even if you back out that excess, it's still an expanding number. So we are not saying that, if you take out this, this, and this, it's clearly terrible. Therefore, we are bearish China. No, this was a good number, but it should have been a good number. And based on the underlying, it was a better number than it should have been, but it's still expanding and it's still reopening. They're still in the process of getting back to some sort of normalcy. And there's still some of that support coming from the government. But the problem is, as these numbers happen, then it's like, and this is why the PBOC, as we talked about last week, was warning companies as well as local governments to, dial back some of the debt, dial back some of the lending, because you also don't want to overheat. And that's some of the balancing act that the PBOC is concerned about when you look at liquidity and when you look at how do you balance that. Because, you could sit here and say, non-manufacturing going to 60 would be great. It's like, in theory, but in actuality, that would be a big concern for the PBOC. And then they may have to say, does this mean we're going to have to start raising rates? Because now you're starting to see things run a bit hot. You're starting to see inflation pressure starting to creep up. So there's a fine line that has to be walked. And the reason why I'm saying that the numbers are good, but not as good as expecting, is because it's going to keep the PBOC on the sidelines. They're not going to increase, but they're also not going to decrease. They're just going to stay the course and let some of these numbers, fix themselves and essentially balance themselves out, which is why it's so important to look at averages. It's so important to look at multiple data sets to understand, manufacturing, as we said, was going to be good, 52.6 expanding, fairly comfortable expansion. The non-manufacturing is the one that is a bit more of a, quote unquote wonky, if you will, or a bit upside down because of the speed of supply chains, because of things of adjusting. And you also have a lot of treasure trove of data coming from last year that came out. And so the annual report summarized key economic data, including GDP, industrial added value, trade, foreign investment. So Shang omitted some disappointing data from the comments that they gave. GDP growth rate was at 3%, which is the second lowest recorded since 1976. Consumption per capita shrunk 0.2% year on year. Industrial profits fell 4%. So free of the zero COVID issues, econ prints this year will definitely improve, but 2022 was a terrible year. So when you have to put it into context of, especially when you start looking at these indexes, January, you still had your people coming back from Lunar New Year. You still had some people shaking off the zero COVID. So February was some of that excess follow through from Jan, which is why March, we'll see some of that ratcheting back. But again, they're still going to be expanding. It's just, it's not going to run at this current pace. bankers in China are being told to rectify their mindsets, which I think is funny. So clean up their hedonistic lifestyle and stop copying Western ways. The directives, part of a 3,500-word commentary last week from the country's top anti-graft watchdog, are just the latest signs that President Xi is going to tighten the Communist Party's grip on the financial system. So when you look at this, one side, they want to improve and increase FDI or foreign direct investment. But yet on the CCP front, they're putting their hands deeper and deeper into the everyday operations from the financial side, having more party members as permanent staff within companies and on boards. And that's not going to jive well with some of these different pieces. So while some of the data has gotten better, there are some headwinds. Now, Lee also highlighted some consumption saw acceleration in January. Lee was giving a sneak peek for the most part because thanks to the Lunar New Year holiday, aggregated consumption data for January and February will be released together in mid-March. It's going to make things look really good. But on a year-on-year level, you're already starting negative from 2022, so it should be good. The question is going to be by how much. And the exports are still likely to be a drag. The property market hasn't fully stabilized despite an initial rebound, which is what we said. It's like, look, it can't keep going down. It's going to bounce at some point, and we've hit that point, and now we see some of that weakness, but consumer confidence is still very low, and again, there's and it's indicated by that weak consumer credit data in January, which we don't see adjusting all too quickly. Now, this chart, I think, puts into context some of the delivery shifts that we've seen and how the latest data points from the February side, when you look at the delivery pieces. So when you look at the China reopening boom, the delivery times in China manufacturing fell to shorter than normal in Feb, joining the US, Germany in negative territory. So when you look at it in terms of the reopening boom, it's more of a deflationary adjustment or a supply chain adjustment, which is going to be an important piece to watch because we see that kind of maintaining the case. And when you look at, again, the understanding what the PMI actually conveys, and when you look at the upside surprises in China, the sector is recovering nicely off of Q4, but it's still markedly weaker year on year. And that's, I think, the biggest key is where are we versus last year? It's still soft. There's still some reopening, but there's still some of that pent-up piece that we've been talking about, which, again, you have to get that through the system. And once you're on the other side, you can start to see a bit more of that balancing act. And then when you look at years of continuous tax and fee cuts for businesses, the government's fiscal revenue is under severe strain. Coming back to the fact that there's not much additional that can be done. So if you start to see things running really hot, the PBOC might say, all right, we have to tap the brakes here because the PBOC, it obviously can't drive taxes, but they can start raising rates and saying, look, the fiscal side is still too easy. We're going to have to increase rates a bit after even we cut some of them. And if you remember, there's a lot of talk about a triple R cut, some additional cuts coming from the PBOC. This data doesn't tell them they have to cut. And I think that's the back and forth with it where you can say, okay, the economy's really strong, things are normalizing, but then on the other side, you're not going to get the stimulus that people were betting on. And that's the mix. So when you look at some of the tax numbers, so in 2022, government tax revenue only accounted for 13.8% of GDP, the lowest in a decade. There's little policy space left to continue to reduce taxes and fees on larger scales. With the zero COVID policy shackles lifted, business operating in China should expect little to zero help with reducing their tax burden in the foreseeable future. And this just puts into context some of the bounces we've seen. So new orders coming back strong. Again, when you go back through 2020, even to 2021, you've had a really slow amount of new orders. So there's a certain amount of pent up capacity. When you look at PMI official going back through 2021, there was that continuous. So people feel much better after finally getting clarity on COVID, finally getting out of the COVID shackles of zero COVID policy or the risk thereof. So therefore, people feel better, and you get that nice spike. Again, as that kind of accumulates and gets baked in, that's when you'll start to see a bit more of that truer data where some of this starts to pull back. China Securities Journal reported that numerous cities have rolled out voucher programs to encourage spending. So there's still this concern about consumption, but now you have to look at this and say, okay, well, if I'm looking at that PMI data and I'm looking at where we are, it's like, how much do we want to drive consumption given we're starting to get into a bit more of an inflationary cycle given some of the speed in which things are moving? On Friday, the Beijing municipal government said it will issue vouchers to coincide with holidays and other peak consumption periods in 2023. Vouchers will range from 100 renminbi to 600 for purchasing items 10 times a voucher's face value. This covers 55 categories of goods ranging from laptops to home appliances. Xinjiang and Shandong intends to issue 8 rounds of vouchers. Nanning, Guangxi is distributing renminbi 30 million worth. These will focus on department stores, e-commerce, restaurants. Cities in Guangdong, Hubei, and Henan provinces have also launched different levels. So these measures they're a Band-Aid rather than an antidote to the structural issues in depressed consumption. But it also leads to, well, how strong are they viewing this? And is this going to create an inflationary spiral that's going to get them into trouble? So it goes both ways. And that's why we're essentially at a pivot point. And it's going to be really important to see how we pivot from here. We think that the pivot shows some slowdown, but still expanding. And that's going, but that's why it's going to be important to see how this is going to impact the consumer. But the stimulus translates into a revival in consumer confidence. It could create positive momentum, but it could also create inflation. Now, Chinese factory activity at a decade high, with the Caxton China manufacturing new orders again bouncing, but there's still some of that disconnect. So local governments saw revenue plummet in 2022. So total tax revenue, which accounts for just under 60% of total government income, contracted 3.5% year on year. Land sale revenue, which accounts for over 35% of local government income, shrank over 30% year on year for more than half of the surveyed regions. To make up for the shortfall, local governments engaged in a variety of one-off revenue-raising measures, increased sales of state assets, housing municipal facilities. Revenue from the disposal of government subsidized housing rose 303%. Many areas intensified efforts to collect overdue debts and fines, doubled down on one-off tax sources like the farmland use tax. Developers are subject to a tax while they temporarily occupy farmland. So many regions face major debt maturation and repayments. So you're just not going to get government support the same way, which is fine because based on some of this, they don't really need it. But if they don't need it, is the voucher system enough to add the level of more debt, or are you going to see that pull back because fiscal revenues broadly match the performance of the economy? So there's expecting some improvement, but there's a lot of debt, there's a lot of roll, there's a lot of interest, and that's going to weigh on things going forward. So then when you look at non-manufacturing PMI, expected at 54.9, came in at 56.3. Caxton China manufacturing PMI, again, coming in at 51.6. So you're getting some of that bounce. But as we said, we expect some of that to come back down and normalize, still in expansionary territory, but just closer towards, let's call it, for depending on which one, 52 or 51.5, 52. So then when you look at the Chicago China Beige Book, you can see fiscal activity improved. And when you look at it in general, it improved year on year, but look at the low it's coming off of. So when you start to average things out, you're not seeing, you want to see a continuation of some of this. And as central banks continue to shed some of the renminbi bonds in 2022, you have a lot of debt coming due. How are you going to support that if other countries are not in any hurry to buy things, which is why maybe that Russian relationship matters a bit more. Change in household net worth last year. Household savings have risen amid weak credit demand, but regulators have asked lenders to front load lending. So the problem is if you front load lending, you can create, again, some of that spiral that we've talked about. So net wealth going back to 2001 was negative. When you look at household saving rates over the four-quarter moving average, it's still elevated, but the net wealth is still down because of the exposure to housing, because of the exposures in general, which makes it a very difficult time to, again, you might get some confidence back, but it's going to be driven by the vouchers. As the vouchers are consumed, are you going to get new demand? If you use a voucher to buy a laptop, well, a laptop will last two, 3, 4 years. Do you need a second one? So again, there's some of that more one-off where, okay, well, you took that demand, now what? And that's that cycle, that fiscal drag that we've talked about, which China's been in for an extended period of time, and it's going to be very hard to shake out of. China's industrial economy is set to disappoint, and it's just because of the overall infrastructure investment. And it's tied to the local government special bond new issuance. And that's where we look at things, because they're going to need the consumer. They're going to need manufacturing, because the special purpose bonds are not going to be able to drive some of these benefits. Industrial profits being weak is going to make manufacturing investments problematic. And then export values are coming down. So we talked about it in segment 1. You have trade coming down, and we're going to talk later on, South Korea, Taiwan. All of these are showing headwinds in general. So once you get out of this reawakening in some of these benefits, when do some of these things start to kind of balance out and see some of these shifts in general? So China infrastructure filling the gap of real estate investment. And the question is can that be maintained given where we are on some of those special purpose bonds? And we don't think it can, which is why the infrastructure filling the gap is going to be very difficult to keep. And that's why some individuals or some investors expect it to stay strong. And we're saying it can't, because they don't have the ability. So instead of giving infrastructure, they can give vouchers. They can give some of these other pieces, which is going to weigh on again, just general growth. So now we look at India. India manufacturing PMI staying strong at 55. India 8 core industries, as we showed before, still staying well above that January average. The question is going to be, how does this heat wave, how do these costs interact? And that's where we have the most concern when we look at India going forward over the next 3 months. Japan department store sales coming down. Again, we see a lot of pressure in terms of just Japanese activity. But one of the things that we wanted to talk the most about is South Korea, because retail sales came in a lighter than December. Department store sales negative. Discount store sales negative. Imports were expected to be up 4.1%, only came up 3.6%. Exports were slightly better than expected, but still negative 7.5%. And industrial production is kind of waffling, but the imports slowing. That's the concern that we've seen. When you look at Korean PMI, it was at 48.5 in Jan, 48.5 here. We don't see that changing. And again, it's just you're kind of holding steady in this kind of like meh view where you're just kind of like, not great, not perfect. We're still contracting, we're not going down further. We don't see any real expansion. And that's this limbo a lot of these developed markets are in, which feed down to some of these other emerging markets. China waking up will be a net positive for South Korea, Taiwan, but again, one-off shocks and as they refill and manage some of their flows. Taiwan manufacturing PMI, coming closer to 50. South Korean exports by dollar volume. So again, there's a mixture of, you're going to get some of that in terms of just the pessimism side around the 12-month outlook eased. And that's a lot of that is with China. China is buying a bit more. You're seeing some of these different flows. But as the supply chains catch up with themselves, you fade because there's the end user. So you're starting at the front end. China reopens. They pull in raw materials, semi-finished products to fill finished products, but how much finished products are left? We've talked about emerging markets, we've talked about developed markets, and we've talked about the US and other developed worlds, and they're just not in a buying backdrop, and that's going to be some of those underlying pressures that will continue. So that's what we have for you today. If you have any questions, you can reach us on Twitter. You can find us in the comment section. Please like, share, subscribe. We appreciate the help, and we hope you enjoy the rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.